Hello, everyone. It's Dane and Cameron here from Mulcahy & Co Financial Planning, presenting to you regarding economies around the world and investment markets and how that's impacted your investments and what we can expect from now until the end of the calendar year. So in the month of October, we did see that the Nasdaq was off by approximately 11%, and the Standard & Poor's index within the US was off by about 9%, and the Australian Stock Exchange here for the ASX 200 was off by approximately 8%. So we did find or feel that there was no one major contributor to that. There was probably a number of just factors that combined for that. And so what did you find that they were, Cam?
Factors of the sell-off, there's a broad range, and there hasn't been one individual that's really sparked this sell-off. The key factors would be rising interest rates in the United States. They've had 7 rate rises in a row, and that's obviously making investors get a little bit more fearful. That time of sort of cheap, easy debt is essentially
which you are seeing here as well within the Australian property market. Not so much our RBA wanting to increase interest rates, but there is obviously a bit of a flow-on effect from there.
Yeah, so our banks obviously borrow a lot of money from overseas and have to pass on some of those higher rates as well. So everyone would know that a lot of the banks have been sold down. The Royal Commission and that sort of thing hasn't been great for stocks, especially banks and the financials. But essentially, the big impact we've seen recently is the sell-off of the Nasdaq, which is actually the tech-heavy stocks in the US, so your Facebooks and Googles and these sort of companies who actually have experienced very strong growth in the last few years.
But you have been worried about that too, haven't we?
Yeah, well, yes, that's right. Well, you look at valuations on a lot of these things, and it's extreme. So the sell-off doesn't really surprise us, and obviously it's filtered into the Aussie market, and we've been hit across the board. There's only a few little shining lights that we've actually seen, but yeah, ultimately, it's been who knows where we head off from here.
Yeah, and you have seen the Australian dollar fall a little bit too, following obviously, US, China, trade wars, etc.
Yeah.
So that would have affected the market a little bit as well.
Yeah, it has. So the trade wars has been a big one, and obviously our dollar's been moving down because most of the defensive money, when equity markets especially get frightened, moves into more safe haven type assets. So first step is usually the US dollar. It's the dominant, it's the powerhouse. It's usually the safest place to park your money, and then it filters down to a few other safe havens past that. So as a lot of clients would know, with our portfolios at the moment, they're quite heavy. There's quite a heavy allocation into precious metals, gold, silver, a lot of the gold miners, etc. So when we've seen this sell-off, we've seen about 10% in these markets being sold off. We've actually seen, the gold index, or a lot of these gold stocks that have moved directly the opposite direction. They're actually up above 10% in this sell-off.
Yeah, so as you touched on there, so predominantly for a lot of our retirees or clients approaching retirement, we do have more defensive type assets in their portfolio. Because we have been a little bit cautious about this or wary of this potentially happening. What have those sort of assets been that we have been including?
Yeah, so as I touched on, so precious metals is really the first one, and then more defensive stock allocations like fixed interest and things like that. So when the market falls, these are things that stay quite stable, and the reason we've done this is because we have been quite fearful in the last 6 months that just in general, valuations are very high at the moment across the board. And we've also had this bull market run in equities for the last 10 years that, technically speaking, we actually are well overdue for a correction in the market. So
which you would say one of the main drivers behind that has been the low interest rates over that period
Absolutely,
of time.
Yeah, it's cheap debt. And that's where I go back to the US raising interest rates 7 times in a row. I think the market, a lot of fund managers especially are getting fearful that time of cheap debt for all these corporations is either come to an end or coming to an end. And what does that mean for equities? Well, it's probably just going to make things a bit harder. And so the sell-off doesn't really surprise us. The only uncertainty is, well, how far can this go and will it go? We're still not saying to dive back in and take the risk at the moment. We're still cautious. Valuations are still quite high. But to sort of stay pretty conservative at the moment is probably the way to go. So with volatility, we'll still be in the market, I would assume, over leading up to Christmas.
Yeah. and we have seen that volatility, so the ups and downs in investment markets obviously increase, probably at least over the last 6 months, if not longer. So for our clients, once again, for those predominantly approaching retirement or in retirement, we have been wanting to take a bit of risk off the table, because the last thing you want to be doing is losing capital.
Yeah, and this is why we set up the portfolios to include the precious metals and some of these things, because it's a bit of a hedge against what happens to the market. So if you look at our portfolios over this calendar year, our balanced portfolio is on track to do about 10%. So through this correction that we've actually had in the markets, we're actually up a little bit, if not a little bit flat, where we've seen the market. So it's doing its job, and that's what we want to see. So it's sort of getting the best of both worlds.
Yeah, as you say, like with those healthy returns of be it above the 10%, it compares in line with be it growth portfolios, but keeping in mind that overall the allocations have been around that 50-50 allocation between defensive assets, so cash and fixed interest, and then 50% towards equities. So from our point of view, we're happy with the way portfolio is positioned, and our clients' portfolios have performed over particularly the last month, which I'm sure some of you would have heard on the news with those corrections. But so for any of you do want more information, by all means, feel free to contact us, myself and Cameron, or anyone in the financial planning team, to book an appointment, so we can spend that time to give you a deeper understanding. Other than that, anything else to touch on?
I'd still stay conservative in the markets at the moment. I think, as I said, volatility is probably still going to be around, and it's still not the time to be taking on the risk. So in terms of valuations, nothing is cheap at the moment still. So just hold tight, and then we'll see how this plans out leading up to Christmas.
No worries. Well, thank you for your time. Once again, any questions, by all means, feel free to contact us. Talk soon. Bye.